Hey, this is Matt from Vista Homes. We're excited to have you join us for our second video. The last video we talked a lot about the location and the importance of getting the right lot for the home you want to build. This week we're excited to talk about financing and the details of financing a new construction home. So there's kind of two ways to fund a home. First is you are extremely lucky and you have the assets immediately available to pay for that home or the construction of that home. And so we work with our clients to set those monies aside in some kind of escrow account. That way they have the monies ready and we have monies to draw from. So it's a third-party escrow account, and so they'll still go through the process of reviewing draws and approving them. So that's one more of another way that it can be done. The second is through some kind of financial institution, a bank or so forth. You can either go through a bank or what they call hard money lending. Sometimes people, if they have credit history issues or they got a new job or for whatever reason the banks won't provide them the loan necessary for a construction loan, they will have to go to a third party or a private institution, what they call hard money. And they typically have a higher interest rates, but they tend to be more flexible in accepting people with credit score issues or issues with down payments, etc. But where a vast majority of our clientele work is with bank institutions. So we work with a lot of different banks, banks that have different structures of way to process loans or process the approvals or so forth. So that is a very common practice, and we have a lot of familiarity with that. All right, hey, we have Carrie Neilson here from Guild Mortgage. We've asked her to come over and maybe just kind of walk us through some of the steps required to get a new construction loan to build with Vista Homes. So Karen, we get asked a lot of questions about the build process. One of the things we get asked are, what do I need to bring to the loan institution to get a loan?
Yeah, the first step is we can do just a basic application. We have an online application that's really like 10 minutes quick, or if you prefer, we can take the information over the phone to do the initial application, or you can come in the office and we can sit down and do it, face to face. And if you are a hourly or a salary borrower, then you would bring just your last two pay stubs. It covers the most recent month, your 2022 and 2023, or last 2 years W-2s, and last 2 months bank statements, just so it shows where maybe your down payment might come from. Now, if you're self-employed, then you would also bring your last 2 years tax returns for personal and business.
Okay, awesome. So if somebody's coming in to get a loan, what are some of the things they should be aware of as far as perhaps their debt or other loans they have or credit scores? What are some recommendations you'd have for them?
Yeah, construction loan's a little bit different than a purchase. So it's a little more conservative than I say a regular purchase. So they're looking about 45% of your gross income. That's before taxes are taken out. And they'll usually qualify you on a payment that's maybe a little bit higher than the going rate, just so there's a little buffer room, because it might be 12 months before you're done with your home. And so there's a little bit of a cushion there, but they'll take your existing loan payments and what your proposed house payment will be, and they want that to kind of fall within 45% of your gross income. So there is some compensating factors too if you need to push those a little.
Okay. Maybe one of the other questions we get asked a lot of, what is the timeline of getting a construction loan? I mean, is it a 2 weeks, 4 weeks, 6 weeks, 10 weeks? What should they expect when they first walk in the door and talk to you and your staff?
Well, to do initial pre-approval, that you could do all within a day. That's pretty quick. But after we have that initial pre-approval amount that you can borrow, that's when you kind of reach out to your builder and sit down, go over budgets, plans, and that can take a while because there's a lot of moving parts when you're building. And once you've got that all solidified, you know exactly, you're going to do a basement, you're not going to do a basement, and what all your costs are going to come, then at that point we'll get the budget, the specifications, plans, everything from your builder, and then we will submit that into underwriting. And if you are also going to purchase a lot at the same time, like you don't own your lot yet, you're going to want to do maybe I would say a 60-day settlement statement on that contract, because you need time to work with you to get your numbers all together and then get your financing through, because we need at least 30 days after you've worked through that process, because we have to get an appraisal, title work, and there's just a few more moving parts, where on a regular purchase that maybe just be 15 to 30 days. I would say it's 30 to 45 days on a construction.
So I got a question asked this morning from somebody that came in. They own a home right now, and they said, well, how does that work to get a construction loan? If I own a home now, I intend to sell that to move into my new home. How does that work?
Well, we have what's called a one-time close with a modification. So it's like the best of both worlds, because on a two-time close, you have two different closings. On a one-time close, you close it and that's it, right? On ours with the hybrid, basically, you don't have to sell that house right up front. You can live in it while you're building.
Okay, good.
We'll usually do like a 12-month construction loan, and we'll start, and as long as you have like a minimum down payment of about 5%, right? And you sell that home maybe, 6 months, 8 months into it, because we still have that 12-month period we can use. And you have like then $400,000 you want to put down on the loan, then they can put it down prior to modification. No mortgage insurance, a lot lower payments than what we initially qualified at the 95%.
Okay, great.
So,
well, thanks a lot. We appreciate you coming in today, and thank you for your time.
Yeah, no
Karen
problem.
Neilson, she's awesome. Guild Mortgage. Thanks. Hey, isn't Karen great? We sure love her. She's great to work with. A lot of our bank friends at the banks are great to work with as well. So we really worked hard to make sure we have the right partners and who we can have you work with to get the funding necessary to build your home. Let's talk a little bit more about the draw process. I mentioned this earlier. So as we go through, and let's say we start building your home, every 2 to 3 weeks, we're going to do what we call a draw. That is when we collect all the invoices and receipts for that period of time. We condense them down to a single report, and we submit that to the bank. The bank then simply says, yes, these monies are appropriate for the budget lines necessary, what we like to call buckets. At that point, then the bank will let you see all those documents as well. One of the big differentiators between us and most construction companies is we let you see every single receipt. We don't add any margin on materials, so what you buy is what you get. So you can go through and make sure all those receipts are what you want them to be. So there's a lot of visibility there and open book policy here at Vista Homes. So that's kind of how the draw process works. Once you approve it, the bank approves it, they will disperse funds. Depending on the bank, depends on how they pay it. Some banks will write the checks themselves and mail the checks themselves. Other banks will write the checks and give them to us and let us mail them. Other banks will then simply just direct fund us into our accounts and have us pay them. And obviously you can get receipts of all those payments at any time. Those liens are placed, so that ensures the subcontractors are paid, so you don't have to worry about any kind of nefarious accounting practices you might have heard about online or so forth. So that's kind of how the draw process works. I also want to talk a little bit about how you build your budgets, the budgets the banks use. In the very beginning, we work with our clients to build what we call an estimate. That is simply just kind of shooting from the hip what we think it's going to take to build that, meaning you want this kind of kitchen, well, it's plus or minus, I'm guessing, this much money. Now, as we go along, we typically get clients that get more understanding and learn more about what they want in their home, and those budgets can change. Those numbers can change a little bit. So those estimates that we build at the very beginning then becomes what we call a budget, and that budget is what we submit to the bank at that during the construction loan approval process. Now the problem is we continue to work with our clients to make select materials, and so what they want may be different than the budget they created at the very beginning. So there has to be a little contingency, a little flexibility in the budget process, because you may want something that may be different than the budget you allocated. So we have to kind of work with that and work with the banks in some of those situations. And so typically banks will require contingency just to ensure that if you do make changes in your selections, that there's funds necessary to pay for them. So when it comes to budget, there's what I call budget busters. There's the two main ones I can think of. The first one is excavation. When we go in to dig a hole for a house, we just don't know what's there, right? We could dig a hole and find a boulder the size of Volkswagen bus that would just be very difficult and costly to remove. We could dig a hole and find an ancient spring of water that could create big problems. So there's a lot of stuff we just don't know. We dig this material out, and the material we have can't be compacted, so we can't use it around the home like we want or in the garage like we wanted. So there's a lot of variables we have to deal with. So that's really where we see if we have any budget busters, that we typically see them in the excavation process. The second one I'd probably point out is lumber. People love to build in the springtime so they can move in by the time the winter comes. The bad side of that is a lot of people do that, so you see higher prices of lumber in the springtime can raise as much as 10-20%, which could, on a normal house, could be anywhere from $10,000 to $15,000 more in lumber costs. So you want to kind of plan around that and be thinking about that as well, because while it has the advantage to build outside of winter, there's a cost associated with some of those things. Other than that, most of the other things, line items, have tended to be somewhat static over the last few years. Things always creeping up slowly, but those are the two things we primarily are concerned about. So that kind of wraps up our conversation this week on financing. Obviously, there's tons more we could talk about, but those are just some high points that we'd like to share with you on how to get a loan, how the draw process works, things you might have to know with working with the bank and so forth. So we appreciate Karen and all our other banking friends that work with us. So thanks for your time today. Next week, we're going to be talking about drafting and how you draft your home and design the home that you want. So thanks for joining us. Go down, click subscribe, click like, share this with all your friends and family. Appreciate your time today. Thank you.